Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Josh Jamner, Investment Strategy Analyst at ClearBridge Investments, with an update on the ClearBridge Recovery Dashboard. Josh, it's great to see you. Welcome to Trade Talks.
Thanks for having me, Jill. Great to be here.
You got it. And you have a fairly optimistic view of the U.S. economy right now. Can you elaborate on that and what you are looking at that leads to that view?
Yeah, so you mentioned our ClearBridge Recovery Dashboard. The overall signal from that dashboard is green. That implies that the economy is in an expansion. 7 of the 9 underlying indicators, we look at things that try to track the health of the financial markets as well as the U.S. economy. 7 of the 9 are also showing that we're in an expansion. And really, it's been that way since about mid-year this year. We're seeing remarkable strength in the housing market. Housing starts, as an example, running about 1.5 million right now. That's a number that is as good as what we achieved really at the very end of the last cycle. So in late 2019, early 2020 was when we were first hitting 1.5 million housing starts. We dropped down below 1 million, and here we are, roughly 6 months off the lows, and from a housing perspective, and we're right back to where we were. So we're seeing a really strong bounce back in the economy, and our dashboard's been saying that the recession ended since whether it was May or June, sometime right around mid-year.
What about the weaker jobs report? Do you think there's a risk of a double dip, or is the economy just hitting a softer patch right now?
I mentioned 7 of the 9 are signaling green. One of the 2 that's not is jobless claims, which is yellow. And absolutely, we had a bit of a softer jobs report last month. Jobless claims came out this morning, a little bit better than the prior week, but it's been a little bit mixed over the last 3-4 weeks now. We fall in the soft patch camp. The data, as we look at it, and again, underpinned by this dashboard, it's signaling that the pace of the recovery is slowing, but importantly, that the recovery is still happening. So at this point, early in the economic cycle, early into expansion, and we're seeing continued growth, but it's just sort of the easy gains have been made, and it's going to get harder and harder from here. But for now, we would believe that it's going to be a soft patch.
So if the economy appears to be continuing its recovery, one of the other major concerns many investors have is valuations. PE multiples are all well above historical averages, but you seem a little bit less concerned about valuations. Tell us why.
Yeah, so I think there's 3 reasons why help us understand why valuations today look stretched relative to history, but maybe get us a little bit more comfortable with where they are. The first of those is just the sector mix of the market today relative to history. So things like energy and financials are at relatively small weight within the benchmark, and they tend to be lower PE groups, cyclical areas. Non-cyclicals, defensives, growth, things like technology, much bigger weight relative to history in the benchmark today, and they tend to trade at a higher PE. So if you adjust for those differences, it's about a 1.5, maybe 2 turn difference relative to history. That alone, if you said historical average over the last 25 years or so, PEs have been 16 to a little over 16. Today we're 21.5 to almost 22 times. We can start to eat away at that gap. And there's some other things. Happy to go into them if you want. I want to just keep talking for ad nauseum, however.
Everyone has an opinion on valuations, that's for sure. But you had a few other key reasons why valuations today are higher that I thought were interesting. Could you discuss a couple of those for a second?
Yeah, so the 2 other ones are lower interest rates certainly has an impact. If you think you get crossover buying from people looking for yield. So the dividend yield in the S&P 500 is about 1.6. If you look at a corporate bond benchmark, the yield on offer is only 1.7. So it's not that big of a gap today. And if you think, at the margin, some investors are going to move out of bonds into equities. It's going to push the P up, right? There's going to be more demand for those stocks. It's going to push the price up. But there's no change in the underlying earnings of those companies. There's a lot of other impacts that low interest rates can have. But just from that dynamic alone, I think there's probably about 1 or 2 more turns, expansion in multiples relative history. And the last one is if you look back historically, we came out, as I said earlier, we came out of a recession, whether it was May or June, sometime around mid-year. And if you look the last 2 recessions, even back further, it's pretty typical to see the early phase of the stock market rally in a new economic expansion being driven primarily by multiples. It happened coming out of the tech bubble. It happened coming out of the global financial crisis as well. So if you look through time, not just during recessions, but through time, about 85%, if you look at a 1-month basis in stock returns, dividends are relatively stable through time. They go up, they go down. We haven't seen any companies cut. I think one company's cut a dividend in the last 3 months. So I think we're probably past the wave of dividend cuts that happened earlier in the year. But on a 1-month basis, about 85% of stock returns are driven by multiples. When you look at 1 year, it falls to 25%. So it completely flips around where earnings tend to take over. And that tends to happen coming out of recessions too. You tend to see, big multiple expansion the first 9 months after the lows. And then as you move into, the next year, the year after that, earnings take over and become the much bigger driver of stock returns going forward. So we've seen multiple expansion off of the lows since late March in US equities. And as we move into 2021, I think earnings will come back. We'll kind of grow into these multiples a bit. It means that multiples are probably likely to drift lower next year. However, I don't think that has to be such a big headwind because earnings growth is so strong. If you look, consensus forecasts are north of 20% right now for earnings growth next year. I think there's probably a little bit of upside to that as we move into reporting season. We'll probably see some more revisions higher, just because some of these companies have guidance out there that still predates the COVID vaccines, being approved, and they haven't been able to mark to market for some of those things. So as we move forward, I think, a little bit lower PEs, but, staying at relatively high level compared to history.
All right, Josh, all great points. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.